Good afternoon, everyone. So, welcome to the session 2 of the presentation on Introduction to AI in Finance. So, today we are exploring how artificial intelligence is revolutionizing financial services from automating the processes and enhancing the decision making to improving the customer experience and managing risk. So, my name is Sakshi Kadam. By allowing the presentation, I grant the permission for it to be uploaded and shared across various social media platforms and the website official website of iCapital Academy and Corporate Advisory LLP. So let's start with our presentation. So the first topic for today is AI in technical analysis. So the definition of AI in technical analysis is AI in technical analysis uses machine learning and data-driven models to analyze the historical market data like price, volume, or indicator to predict the future price movement. The key application in AI in technical analysis is pattern recognition, predictive models, trading boots, and strategy optimization. So the pattern recognition is which the AI detects the complex patterns, for example, head and shoulder flag with high accuracy. Predictive models uses neural networks, for example, LSTM, to forecast the stock trends based on the time series data. Trading boots, AI-driven boots make real-time buy or sell decision using technical indicators. Uh, Strategy optimization. AI backtest and improves the trading strategy for better returns. So, what are the benefits of AI in technical analysis? It is fast and accurate analysis. It reduces the emotional biases, learns and adapts to market changes. What are the challenges which AI and technical analysis face? Is they have the risk of overfitting, black box decision making, limited during market anomalies. Next is market news analytics. So the definition is market news analytics refers to the process of analyzing news articles, press release, blogs, and social media content to extract the insights that impact the financial market. It uses natural language processing (NLP) and AI algorithms to quantify the influence of news on stock price, sectors, or the entire economy. Let's see the key components of market news analytics. The first is news sentiment analysis, which classifies the news as positive, negative, or neutral, which helps the traders understand how the market might react to a new event. For example, positive earning report, which is equal to bullish sentiment. The second is real-time news monitoring. The tracks breaking news and automatically alerts the investors usefully for high frequency and algorithm trading. The third is event detection. Identifies the impactful events like merger, bankruptcies, policy changes, etc. So AI filters the noise and highlights the market moving events. The fourth one is news impact scoring, assigned in scores to uh, based on potential market impact. Like for example, central bank rate high, which is high impact score. So let's see the technological use. So NLP, which is natural language processing, which is extract the keywords, entities, company names, and sectors and tone. And machine learning predicts the price movement based on the historical news trends. Big data analytics processes the massive volumes of news across the multiple sources. The benefits are early identification of trading opportunity, better understanding of market sentiment, supports the risk management and decision making, The challenges are handling fake and misleading news, interpreting the sarcasm, irony, and ambiguous language, real-time processing of large data volume. So the next topic is derivative and AI trading models. AI models analyzes the historical data to identify the pricing, inefficiency, and patterns in derivative instruments. Machine learning helps build the predictive models for option, future, and swaps, automates the hedging strategies and risk assessment in real time, enhance the price accuracy and trade execution speed, used in portfolio management to balance the derivative exposures and dynamically. So, what are the derivatives? The derivatives of the financial contract whose value is derived from an underlying asset like stocks, commodity, currency, or indices. Common types are future, options, swaps, and forward. Futures are the agreement to buy or sell at a future date at a fixed price. Options is a right but not obligation to buy or sell at a specific price. And swaps and forward used for hedging and speculation. So how AI is used in derivative trading is price models and risk management, which AI improves the traditional models like black holes by learning from historical price behavior. Machine learning predicts the option premium, volatility, and Greeks, delta, gamma, etc. The second is strategy development, which AI identifies the pattern in derivative market to build the profitable strategies like calendar spreads, delta neutral strategy. The third is predictive analysis. The AI forecasts the underlying asset price movement and derivative contract values using models like LSTM, which is long short-term memory, random forest, and boosting. Fourth one is algorithm and high frequency trading. So AI model automates the trading of future and option based on market signals, real-time sentiment, technical indicator. So let's see the benefit of AI in derivatives. It is faster and it is more accurate. It has more accurate pricing. Second is improve the hedging strategy. Third is it reduces the human error, and the fourth is real-time market responsiveness. Let's see the challenges. The challenges which faced is the data quality and noise in high frequency trading, regulatory and compliance risk, model overfitting in complex markets. The next is real-time surveillance of traders. So uses AI in monitor trading activities continuously and detects suspicious behavior, helps to prevent the insider trading, spoofing, and market manipulation. Automates alert and compliance reporting in real time, enhance the market transparency and regulatory adherence. AI models analyze a large volume of transactions to identify the anomalies instantly. So let's see the definition. The real-time trade surveillance refers to the continuous monitoring of trading activities as it happens to detect the suspicious behavior, market manipulation, or violation of regulatory rules. The objective of uh, the objective of real-time surveillance of trades is detect the insider trading, front running, or spoofing, ensures market integrity, comply with regulation, for example, SEBI, SEC, MIFID. Second, let's see the key features. The key features is live monitoring, AI and machine learning, behavioral pattern recognition, alerts, and dashboards. Live monitoring analyzes the every trade, order, and cancellation in real time, flags unusual pattern, for example, large trades, rapid order changes. AI and machine learning learns trading behavior to detect the anomalies, predict the potential compliance risk before they escalate. The third is behavioral pattern recognition, tracks traders' historical behavior, detects the deviation from normal activity, alerts and dashboard, generates automatic alerts for compliance teams, visual interface for quick review and investigation. Technology used technology used by real-time surveillance is big data platform, which is Spark for high volume data, NLP for analyzing the communication, email chat, rule-based engines combined with AI models. The benefit is immediate detection of market abuse, faster compliance response, reduce the regulatory fines and reputation risk, enhance the investor confidence. The challenges is high cost of infrastructure, managing the positives, keeping up with the evolving trading tactics. For example, National Stock Exchange and Bombay Stock Exchange survivalist systems use AI to track unusual price movement and insider trading in real time, automatically alerting the authorities when the threshold are breached. So the next is price prediction using AI. So AI uses historical financial data and machine learning algorithms to predict the future price of assets like stocks, currency, or commodities. It identifies the pattern, trends, and anomalies to make the accurate real-time forecast, helping investor and trader make informed decisions. Let's see the definition of price prediction using AI. The price prediction using AI refers to applying machine learning, deep learning, and statistical models to forecast the future prices of assets like stocks, commodities, or cryptocurrencies based on the historical and real-time data. So let's see how AI predicts the price. The first is data collection and pre-processing. The data collection and pre-processing collects the historical price, volumes, technical indicator, macroeconomic data, news sentiment, etc., and cleans and structures the data for training AI models. The second is model selection. Common model used is linear regression, LSTM, which is long short-term memory, random forest, and light GBM. So in model section, the common model used is linear regression for trend analysis, LSTM, which is long short-term memory, which handles the time series prediction, random forest, which captures a non-linear patterns, and like GBM or XD boost, which is fast and accurate tree-based method. Third is training and testing. In training and testing, AI models learn from the past patterns and are tested on unseen data, which performance is measured using the metrics like RMSE, MAE, or R square score. Fourth is real-time forecasting. Once trained models provide a real-time prediction to guide the trading decision. For example, input of AI pricing model is technical data, fundamental data earnings, sentiment data, and market data. Technical data is for example, moving averages, RSI, MACD. Fundamental data earning is PE ratio or revenue. Sentimental data is news, the news headlines, social media sentiment, market data, volume, volatility, order book data. The benefits are that it detects the complex pattern humans may miss. It generates the high frequency or long-term forecast. It supports the algorithmic and quant trading, and it reduces the reliance on manual analysis. The challenges were it is a prone to overfitting on historical data, may fail during the black swan events, requires a high quality real-time data and limited interpretability of deep models. The real world uses cases is Bloomberg Terminal uses AI to forecast the stock movement. Quant hedge fund, for example, Two Sigma deploy AI models for daily prediction. Uh, Retail apps, for example, Upstock, Grow, of some offer AI assistant stock tips. So the next is quantitative finance and AI. The Aladdin, it is asset, liability, debt, and derivative investment in network is a BlackRock AI-powered platform. It manages the risk analysis, portfolio management, and trading operation for institutional investor. Uses the AI to analyze the massive data set for market trends, investment risk, and performance forecast. Helps the clients to data-driven the investment decision and optimize the portfolios. Widely adopted across the global financial institutions for its scalability and accuracy. The definition of quantitative finance in AI is the quantitative finance uses the mathematical models, statistics, and algorithms to analyze the financial market and make trading risk and investment decisions. AI artificial intelligence enhance the quantitative finance by adding the powerful capabilities for pattern recognition, forecasting, and automated decision making. Let's see the key areas where the AI made the quantitative finance. The first is algorithm training, second is portfolio management, third is risk management, fourth is price prediction and forecasting, and the fifth one is sentiment analysis. Let's see the first key area where the AI meets quantitative finance is algorithmic trading. The algorithmic trading is AI-based model trade based on the real-time market signal, uses machine learning to adapt and optimize the strategies, handles the high-frequency trading, which is HFT, with speed and precision. The second is portfolio management. AI assists in asset allocation using reinforcement learning or optimization algorithms. Tools like robo-advisor uses AI to tailor the portfolios based on the investor goals. The third is risk management, predicts the market downturns and identify the portfolio risk. AI model detects the credit defaults, fault, fraud, and liquidity risk faster than the traditional models. Predict price prediction and forecasting. Machine learning model uses LSTM, which is long short-term memory, XG boost, forecast the stock price, volatility, or asset return based on the historical data, useful in options, pricing, and derivative valuation. The fifth one is sentiment analysis. The sentiment analysis AI extracts the market segment from news, earning report, or social media. Quant models integrate sentiment as a predictive signal or in trading strategy. Let's see the popular AI technique used in quant finance. The technique are the regression model, neural network, natural language processing, reinforcement learning, clustering algorithms. Now see the use cases example. In regression model, it predicts the asset returns. In neural network, it patterns the pattern recognition in time series. Natural language processing is analyzing the financial news or tweets, and reinforcement learning dynamic portfolio optimization, and clustering algorithms is identifying the similar asset behavior. The benefits are the faster data processing and decision making, enhanced prediction accuracy, adaptive adaptive to change market conditions, and automates the complex trading and investment tasks. The challenges are data quality and availability, model transparency and explainability, overfitting risk in unstable market, and regulatory and ethical concerns. The real world use cases is Two Sigma and Citadel, BlackRock, Aladdin, Bloomberg Terminal. In Two Sigma and Citadel is AI-based quant funds from HFT, and BlackRock's Aladdin is risk management using AI and quant models. And in Bloomberg Terminal, AI tools for market analysis. So now let's see the next topic, which is case study, which is Renaissance technology. The Renaissance technology is a hedge fund known for its quantitative and algorithmic trading for trading strategies powered by AI and advanced math. Uses the vast amount of market data and analyze with the machine learning to identify the trading opportunities, employs the sophisticated AI models to execute high frequency and systematic trades, achieve consistently higher returns with minimal human intervention, and recognized as a pioneer in applying AI and data science for finance. Let's see the overview. The it was founded by James Simpson in 1982. The headquarters in East New York, USA. Fund name is Medallion Fund, which is flagship hedge fund. Specialization is quantitative trading using mathematical model and statistics and AI. So the core strategy, quant plus AI plus big data. The the Renaissance technology uses scientific methods, machine learning and AI to detect the pattern in vast amount of financial data and trade automatically. The key characters is the employees PhD in physics, mathematics, computer science, very few finance professionals. Focuses on the data-driven trading decision, not human intuition. Trades across the multiple asset classes, equities, futures, currency, etc. Uses proprietary algorithms that are constantly refined using AI and machine learning. AI and machine learning in action. It's patterns recognition. AI identify the subtle non-linear pattern from the terabytes of market data. Self-learning model algorithm learns from the past trades to improve the future strategies. Text analytics is NLP, it is natural language processing, is applied to news, economic releases, and even weather data. High frequency trading, which is HFT, which executes the trades in milliseconds based on the micro signals. The performance is the Medallion Fund average return is 66% annually before fees and 39% after fees over 3 decades, only open to employees due to its extreme profitability. Secrecy and competitive edge is Renaissance is highly secretive about its method and model, maintains strict data control and tight collaboration between the teams. Black box models are not publicly explained even to the investor. The challenges faced were is regulatory scrutiny on model transparency, high cost for computing and infrastructure, need to retain and optimize the AI models, risk of overfitting and reacting to false signals. The key lessons from resilience technology is data in alpha, which is more data, better prediction when handled properly. Interdisciplinary teams is combining math, coding, and finance, yielding innovation. And AI plus oversight AI is powerful but still requires careful tuning. And secrecy is a strength. Intellectual property is heavily guarded. So the next is anomaly detection in trading. AI systems monitor the trading to identify the unusual patterns or behavior that may indicate the error, fraud, or market manipulation. By spotting these anomalies in real time, AI helps to ensure the market integrity, reduces the risk, and prevent the financial losses. So let's see the definition of anomaly detection in trading. Anomaly detection in trading refers to the use of AI and statistical models to identify unusual or abnormal trading behavior that deviates from the expected pattern, which could indicate the fraud, market manipulation, or system error. The purpose of anomaly detection in trading is it detects the suspicious trade, like for example, insider trading, spoofing, wash trading. And it identifies the system failures, price glitches, or sudden volatility, ensures the market integrity, and support the regulatory compliance. Let's see how it works. Uh, it data collection the data collection uses the historical trade data like price, volume, overflow, execution time, trade ID, etc. Feature engineering extract the key metrics like trade size, price movement, order frequency, etc. AI and machine learning algorithm use is the model type are statistical models, unsupervised machine learning, deep learning, time series model. In statistical models, it uses the Z-score IQR to detect outliers. Unsupervised machine learning is K-means, DBS scan, uh, isolation forest. Deep learning is autoencoders for complex anomaly patterns. And time series model is long short-term memory to flag time-based anomalies. The real-time monitoring is AI tools flag abnormal activity instantly and generate alerts for review. The benefits of are to it improves the fraud detection and risk control, supports the regulatory compliance like SEBI, for example, SEBI, SEC, MIFID second, reduces the financial losses from undetected error, enhance the investor trust in trading systems. The challenges were high false positive trades, need for high quality labeled data, difficulty in detecting the subtle involving the manipulation, interpretability of AI of complex AI models. Real world application is uh, Nasdaq Smart Surveillance, JP Morgan and Goldman Sachs. SEBI's Integrated Market Surveillance System is IMSS. In Naxal Smart Surveillance, it detects the market manipulation using AI, and JP Morgan and Goldman Sachs uses the anomaly detection to monitor the employees' trading. In SEBI's Integrated Market Surveillance Systems, which is IMSSS, it tracks the abnormal trading patterns in India. So the next is AI-driven portfolio rebalancing. The AI-driven portfolio rebalancing, which is AI continuously analyzes the market condition and portfolio performance to automatically adjust the asset allocation. This helps to maintain the desired risk level and optimize the returns by rebalancing investment efficiently and timely without manual intervention. So, what is portfolio rebalancing? Portfolio rebalancing is a process of adjusting the weight of asset in an investment portfolio to maintain a desired risk return profile after a market movement change the asset value. Like how AI enhance the portfolio rebalancing is dynamic risk assessment. AI model continuously analyze the market data to assess the portfolio risk in real time, can detect the shifts in volatility, correlations, and asset performance. Second is personalized strategies, uses in investor goals, risk tolerance, and constraint to customize the rebalancing pattern. Like AI can learn and adapt to changing investor preferences over time. Optimal timing. AI predicts the best times to rebalance the minimize the transaction cost and taxes. Avoid the unnecessary trading by forecasting market trends. Automated execution. AI powered performance can automatically execute trades from rebalancing without human intervention. Ensures portfolio by stay aligned with the target allocation efficiently. The technology used is machine learning, for example, reinforcement learning for adaptive strategy, optimization algorithm to minimize the risk and cost, big data analytics to incorporate a diverse market signals. The benefits were is improve the portfolio performance by staying aligned with the object, reduces the emotional and behavioral biases, saves time for effort through automation, enhances the text efficiency and cost management. The challenges were it requires a quality and a timely data. Complex models may lack transparency, but must balance between the frequent and infrequent rebalancing. For example, robo-advisor like Wealthfront and Betterment use AI to offer the personalized automated portfolio rebalancing to retail investors. Next is dynamic asset allocation. AI dynamically adjusts the mix of the assets in a portfolio based on the changing market condition, economic indicator, and investment goals. This adaptive approach aims to maximize the returns and manages the risk by continuously optimizing asset and distribution. So, what is dynamic asset allocation? Dynamic asset allocation is an investment strategy that actively adjusts the market of asset classes, stock, bond, or cash, etc., over time based on changing market condition and economic outlook. How it works. Unlike static allocation, dynamic allocation respond to the market signals like volatility, interest rates, and economic indicator. Portfolio weights are regularly rebalanced to capture the opportunities or reduce the risk. The strategy aims to maximize the returns while managing the risk through the flexibility. The role of AI in dynamic asset allocation. Market condition analysis. AI analyzes the real-time data, economic report, price trends, sentiment to predict the market shift, risk and return optimization. Machine learning models forecast the asset return and risk, helping to select the optimal allocation. Adaptive strategy. AI continuously learns and adapts the allocation decision based on the new data. Automated rebalancing executes timely adjustment to portfolio composition with minimal human intervention. Benefits: it is responsive to market changes, potential higher return with controlled risk, reduces the emotional bias in decision making, scalable and customizable to the investor goal. Challenges were requires accurate, timely data, complex model may be difficult to interpret, and overfitting the risk if models are too sensitive to short-term noise. For example, fund using AI-driven dynamic allocation adjusts their exposure to equities, bonds, and alternative based on a predictive market cycle. The next is forex trading and AI. AI analyze the vast amount of currency market data in real time to identify trends, predict price movements, and execute the trade automatically. It helps to improve the decision making, manage risk, and capitalize on market opportunity faster than humans. What is forex trading? Forex means foreign exchange. Trading involves the buying and selling currency to profit from fluctuating in exchange rates. How is AI used in forex? The market analysis and prediction. AI analyze the vast amount of historical and real-time data to predict the currency price movement. Uses models like LSTM, which is long short-term memory, random forest, neural networks for forecasting. The second is algorithm trading. AI-powered trading boost executes the trades automatically based on the program strategies and market signals and can react faster than human trades to market the changes. The third is sentiment analysis, which AI tools analyze the news, social media, and economic report to gauge the market sentiment influencing the currency prices. Risk management. AI models help that manage the risk by setting stop, loss limits, and adjusting trade sizes based on the volatility. The fifth is trade optimization. Machine learning algorithms optimize the entry and exit point to maximize the profit and reduce the losses. Benefits are 24 by 7 market monitoring and trading, fast decision making with reduced emotional biases, ability to process and learn from the large data set, enhance the risk and money management. Challenges is high volatility and unpredictability in forex market, requires a constant model update and fine tuning, risk of overfitting to historical data, dependency on data equality and connectivity. For example, of AI in Forex is it is AI-driven platform like MetaTrader uses expert advisors like EAS for automated trading. Hedge fund and proprietary trading firm employs AI models for currency strategy. The next is ethics in AI-driven trading. This involves ensuring AI trading systems operate fairly, transparently, and without bias. It includes the preventing market manipulation, protecting investor interest, maintaining accountability for AI decisions, and complying with the regulation to avoid harmful financial impacts. Ethical and AI trading promotes trust and market stability. Why AI ethics matter? So the AI-driven trading involves the automated decision making that can impact the market, investor, and the economy. Ethically consideration ensure the responsible use of AI to maintain the fairness, transparency, and trust. The key ethical issues in AI in trading is market manipulation risk. AI system might unintentionally engage in or amplify the manipulative behavior, for example, spoofing need safeguard to prevent unfair market practice. Second is transparency and explainability. Many AI models like deep learning and black boxes with decisions are hard to interpret. Traders, regulators, and investors require clarity on how AI makes changes decisions. Third is bias and fairness. AI can inherit the biases from trading data, leading to unfair advantages or discrimination. Ensuring unbiased data and equitability access to AI tools is essential. Accountability when AI causes loss or market disruption, it is critical to determine who is responsible and that the developer, trades, or firm. Clear accountability framework are needed. Privacy concern. AI uses large data sets, sometimes including sensitive information. Respective data privacy and complying with the regulation like GDPR is vital. Six is impact on employment. Automation may reduce human trading roles, raising concern about job displacement. Best practices for ethical AI trading is implement the robust monitoring and control systems, use transparent algorithms where possible, regularly audit AI models for bias and fairness, maintain the human oversight alongside AI, and ensure the compliance with law and regulation. Regulatory context like SEC, ESMA, and SEBI are developing guidelines on AI which is using in trading. Like firms are expected to demonstrate the responsible AI deployment. So the next is AI in insurance and credit. Underwriting AI. AI in underwriting uses data analysis and machine learning to access the insurance or loan risk faster than and more accurately. It automates the evaluation of application, predicts the potential defaults or claim, and helps the customize the price based on the risk score profiles and improving the efficiency and decision quality. So the first is risk assessment and underwriting. AI analyzes the vast data set, medical records, driving habits, and claims history to more accurately assess the risk and prime premium. The second is claim processing. AI automates the claim verification using image recognition, for example, accident photos, natural language processing for claims forms for speeding up the approvals and reducing the fraud. Customer service, the chatbots and virtual assistant provide 24/7 support, answering the queries and guiding customer through policy details. And the fourth is fraud detection. AI detects the unusual claim patterns and flag potential for using the anomaly detection algorithm. The second is AI in credit. The AI credit scoring. AI model access the credit worthiness beyond the traditional credit scores by analyzing the alternative data like transaction history, social behavior, and payment patterns. Loan approval automation. AI automates the evaluation process, speeding approval and reducing the manual error. Risk management. Continuous monitoring of borrowers' financial health helps to predict their defaults and manage the portfolio risk. And personalized offers. AI tailors the loan product and credit the limits to individual customer profiles and needs. The benefits are it is faster and more accurate decision, improve the customer experience, reduce the fraud and default rate, and expand the financial inclusion through the alternative data. The challenges were data privacy concern. The challenges were data privacy concerns, algorithmic biases affecting fairness, regulatory compliance complexity, and dependency on quality and quantity of data. So the next is fraud detection in insurance. AI helps detect the fraudulent claims by analyzing the pattern and anomalies in insurance data. It uses the machine learning to identify the suspicious behavior like false claims and reduces losses and speeds up the investigation and improves the accuracy in fraud prevention. So what is fraud in insurance fraud? The insurance fraud involves a deliberate decision to obtain the unjust benefits such as false claims, inflated losses, and staged accidents. How AI helps in detect the insurance fraud, which is data analysis. AI analyzes the vast amount of structure, claim, and policies and unstructured data, which is email, photos, and social media. Anomaly detection. Machine learning model flag unusual patterns on inconsistencies in claims, for example, repeated claim, suspicious timing. Natural language processing extracts the key information from the claim forms, register notes, and customer communication to spot the suspicious language or uh, contradiction. Next is image recognition. Analyzes a photo or video of damage to verify the authenticity and detect the manipulation. Predictive modeling. AI predicts like likelihood of fraud before claims the approval, enabling the early intervention. Benefits the faster identification of fraudulent claims, reduces loss and improve the profitability, enhance the investigation efficiency, improve the customer trust and satisfaction. Challenges are balancing fraud detection and false positives, data privacy and ethical concerns, integration and with legal insurance system, and need for continuous model updates to catch involving in fraud ethics. The real world use case is the companies like Progressive, Allianz, and State Farm use AI powered fraud detection system to safeguard their claims processes. So the next is claims management automation. AI automate the process of handling the insurance claims from initial filing to the approval and payout. It speeds up the claim and processing, reduces the manual error, detects the fraudulent claims, and improves the customer satisfaction by providing the faster resolution. What is claim management automation? It is the use of an AI and digital technology to automate the end-to-end process of insurance claims from filing to settlement, improving the speed, accuracy, and customer experience. How automation works in claims management. Claims takes intake the and registration. Automated system captures the claim via web, mobile apps, or chatbot without manual input. Second is document and data processing. AI-powered optical character recognition, which is OCR, extract the information from forms, photos, and reports. NLP is natural language processing. It interprets the customer communication and document. Fraud detection and validation. Integrate the fraud detection models, flag suspicious claims early in the process. Damage assessment. Image recognition. Analyze the photos or videos of damage for automated damage estimation. Decision making and settlement. AI models approve the simple claims instantly to route complex claims to human adjusters and automate the payments, speed up the settlement. Benefits is faster claim processing and settlement, reduce the operational cost, enhance the accuracy and fewer errors, improve customer satisfaction and experience. The challenges is integration with the existing legacy systems, ensuring data security and privacy, handling the complex and ambiguous claims, acquiring human judgment, and continuous training and updating of AI in models. For example, companies like Lemonade, Metromile use AI-driven automation to process the claim quickly and sometimes settling in minutes. So the next is dynamic risk-based pricing. So AI adjusts the insurance and financial product price dynamically based on the real-time assessment of individual risk factor. It uses data analytics and machine learning to set the personalized premium that reflects the true risk profile and improving the fairness and competitiveness. So, what is dynamic risk pricing? Dynamic risk based pricing is a price strategy where insurance premium or loan interest are adjusted in real time based on changing the risk profile of the individual or asset. So, how it works? It is a continuous risk assessment. AI models analyze the real time data, for example, driving behavior, credit usage, health metrics to update the risk level. Personalized pricing, the premiums or rate are tailored dynamically according to the assessed risk rather than the fixed static rates. Third is data source used is telematics for auto insurance, financial transaction and credit history, variable and health data for life or health insurance, and behavioral data for apps and IoT, which is device. Automated adjustment. Pricing changes are applied automatically, reflecting current risk, in, incentivizing safer behavior. Benefit is fairer prices based on the actual risk, encourages the positive behavior, for example, safe driving, improves the risk management for insurance and lenders, and increases the customer satisfaction and loyalty. Challenges are the privacy concerns and over the continuous data monitoring, complex regulatory compliance, risk for of pricing volatility and frustrating customer requires a robust data analytics and infrastructure. For example, usage-based insurance (UBI) is auto insurance like Progressive offer dynamic premiums based on the driving patterns. Credit card companies adjust the interest rate based on the real-time credit risk and assessment. The next is virtual insurance assistance, AI-powered digital assistant that helps the customer with an insurance-related queries, claims filing, policy information, and personalized recommendation. They provide 24/7 support, improve customer experience, and reduces the workload on human agents. So, what are the virtual insurance assistants? The virtual insurance assistants are AI-powered chatbots or voice assistants designed to help the customer with insurance-related queries and tasks anytime, anywhere. The key functions are the customer support, which answer the policy questions, provide the quotes and product information, guide customer through claim filing and status updates, policy management, helps in renewal, cancellation, and updates, assist in the document submission and verification. Third, claims and assistance is guide user through the claims processes, automate the initial claim intake and data collection. The fourth is personalized recommendation, which suggests the insurance product based on the customer profile and needs. The benefits, the benefits is it is 24. The benefits is it is available 24/7, improving the customer service, reduces the operational cost for issuers, faster response times, and reduces the wait time, enhance the customer engagement and satisfaction. Challenges: handling the complex and unusual inquiries, maintaining the data privacy and security, ensuring the smooth handoff to human agent when needed, and language and context understanding limitation. For example, progressive flow chatbot answer the customer queries and assist with claims, and alienized chatbot provides the instant quotes and policy information. The next is telematics and AI in car insurance. AI analyze the data from telematics devices like DSP and sensor installed in car to monitor the driving behavior. This helps the insurers assess the risk more accurately, offer personalized premium, detects fraud, and improve the claims processing. It encourages safer driving and reduces the cost. So, what is telematics? Telematics involves the collecting the real-time data on a vehicle usage, driving behavior, location, speed, and other parameters using DSP and onboarding sensors. How AI and telematics work together in car insurance. Data collection. Telematics devices track the driving habits such as acceleration, braking, cornering, and mileage. Risk assessment and pricing. AI analyzes the telematics data to access the driver risk more accurately. Enables usage-based insurance UEI, where premium reflects the actual driving behavior. Personalized premium. Safer drivers get lower premiums as AI adjusts their pricing dynamically, encouraging the responsible driving through feedback and incentives. Claims and accident detection. AI detects the accident from the sudden change in telematics data, facilitate the faster initiation and fraud detection. Driving coaching. AI provides a personalized tips to improve the driving habits and reduce the risk. The benefits is this fairer behavioral based price, encourages the safe driving, faster claim processing, and reduces the fraudulent claims. Challenges is privacy concern over a continuous monitoring, data security and consent management, infrastructure cost of data processing, potential resistance for customers fearing survivability. For example, progressive snapshot program uses the telematics and AI to offer the personalized rates. Analyze and AXA uses the telematics data for dynamic pricing and driver feedback. So the next is predictive analytics for claims. AI uses historical claims like data and pattern to predict the likelihood, cost, and type of future insurance claims. This helps the insurers that detect the fraudulent claims early, speed up the claim processing and optimizing this resource allocation for better customer service and cost control. So, what is predictive analysis in claims? Predictive analysis uses AI and machine learning to analyze the historical claims data and predict the future outcomes, improving the claims handling and risk management. How predictive analysis works in claims? Data collection and integration combines data from the claims history, customer profiles, policy details, and external sources. Pattern recognition, it identifies the trends pattern associated with the claim frequency, severity, and fraud risk. Risk scoring, assign the risk scorers to new claim to prioritize the investigation or fast track approval. Outcome prediction, forecast the claims cost, settlement time, and likelihood of fraud or litigation. Resource optimization helps to allocate the adjuster and investigators efficiently based on the predicted claim and complexity. Benefits is it is faster claim resolution, reduces the fraudulent and inflated claims, improve the customer satisfaction, cost saving through bank resources and allocation. The challenges were the data quality and completeness and data model bias and fairness concern, integrating the predictive model with legacy systems and need for continuous model update. For example, insurance like Allianz and State Farm use predictive analytics to streamline the claims workforce and detect the high risk claims early. So the next is AI in life and health insurance. AI helps the insurers assess the risk more accurately by analyzing the medical record, lifestyle data, and genetics information. It streamlines the underwriting, speeds up claims the processing, and personalized policy recommendation, and improves the fraud detection, ultimately enhancing the customer experience and operational efficiency. So let's see how AI is transforming life and health insurance. The first is underwriting and risk assessment. AI analyzes the medical record, genetic data, lifestyle habits, and wearable devices data to assess the risk and more accurately. Enables the personalized premium based on the individual health profile, claims processing, automates the verification and approval of the health and life insurance claim using NLP and image recognition, speed up the settlements and reduces the fraud. And third is customer engagement. Virtual assistant and chatbot provide 24/7 support for policy information, claim status, and health tips. The fourth is health monitoring and prevention. AI integrates data from wearable and health apps to monitor the policyholder health and recommend the preventive measure. Supports the wellness program that reduces the claim. The fifth one is fraud detection. It detects the inconsistency of suspicious patterns in claims and medical reports using anomaly detection model. The benefit is are it is more accurate risk pricing, faster and fairer claims handling, enhance the customer experience, and supports the proactive health management. The challenges were privacy and data security concern, ethical use of sensitive health data, regulatory compliance with HIPAA, GDPR, need for high quality, diverse data sets. For example, companies like Oscar Health and Cigna use AI to personalize the insurance and improve the care. AI-powered tools analyze the imaging and diagnosis to assist the underwriting decision. So the next is client segmentation. AI analyze the customer data to group clients based on the behavior, needs, and risk profile. This helps the insurers, trailers, tailors product marketing and service to specific segments, improving the customer satisfaction and business efficiency. What is client segmentation? Client segmentation is the process of dividing customer into distinct groups based on the shared characteristics such as demographic, behavior, need, or value. Why is client segmentation important? Which is it because it enables the personalized market and services, improves the customer engagement and retention, helps to identify the high value client and tailor offers, optimize the resource allocation and sales strategies, how AI enhance a client segmentation, data collection and integration combines the data from the transaction interaction, social media, demographic and more. Clustering algorithms uses machine learning methods like K-means, DBS scan, and hierarchical clustering to groups similar clients. Behavioral analysis, AI analyzes purchasing pattern, product usage, and response to the campaign. Predictive segmentation, predict customer lifetime value, CLV, churn risk, and unspell the opportunity within the segment. Benefit is more effective targeting marketing campaign, increase customer satisfaction and loyalty, better product recommendation, improve sale and revenue growth. The challenges is the data privacy and compliance issues, ensuring data quality and completeness, segments the stability over time, and interpretability of complex models. For example, retailers and financial institutions using AI-driven segmentation to personalize the offers and improve the cross-selling. So the next is credit scoring. The credit scoring model AI uses data and machine learning to assess an individual credit worthiness by predicting like likelihood of loan repayment. This model analyzes the financial history, behavior, and other factors to provide the faster and more accurate, unbiased credit decisions. What is credit scoring models? And credit scoring model is a statistical or a machine learning model used to evaluate a borrower's credit worthiness or based on the various financial and behavioral data. The key component of credit scoring models are input variables, credit history, past loans, repayment behavior, incomes and employment status, debt to income ratio, credit utilization, and demographic information. Model type is logistic regression, classical, classic and statistic method predicting profitability of default. Decision tree and random forest capture the non-linear relationship and interaction support vector machine SVM for complex classification tasks, and, and neural network handle large complex data set for improved accuracy. Output a score for profitability indicating likelihood of default and timely repayment. Benefit faster, more objective lending decision reduces the credit risk for lenders, enabling the financial inclusion by evaluating the alternative data, helps the set interest rate and create the limit approximately. Challenges potential biases in data leading to unfair lending, need for regular model validation and updating, privacy concern in data usage, and regulatory compliance requirements. For example, FICO scores is widely used credit scoring system. Model fintech use AI-based models incorporating social and interaction data for enhanced scoring. Credit monitoring systems. What is credit monitoring systems? AI-powered systems continuously track and personal credit activity and alert them into important changes or potential fraud. They help the user manage their credit health by providing the real-time update on credit scores, new inquiries, and unusual account behavior. A credit monitoring system continuously tracks and analyzes a borrower's credit profile and financial behavior to detect the changes that may indicate the increased credit risk. How credit monitoring system works, data collection. It gathers data from credit bureaus, financial institutions, transaction record, and other sources. Real-time analysis. This uses AI and analytics to monitor changes in credit score, payment history, and debt level, and news credit inquiries. Alerts and notification sends alert to the lenders or borrowers about significant credit events such as missed payment, default, or suspicious activity. Risk assessment continuous update risk scores to help to lenders to manage the portfolio proactively. Benefits and early detection of for potential defaults helps to prevent fraud and identify the identity theft, enabling the proactive risk management, improves the loan portfolio health and decision making. The challenges are data privacy, security concern, integrating with the multiple data sources, managing the false positive, ensuring the compliance with the regulatory requirements. For example, credit bureaus like Experiana, and Equifax offers the credit monitoring services. Banks uses the credit monitoring to flag the risky borrower and adjust the credit limit accordingly. The next is fraud detection with AI. AI model analyze the historical financial data and behavioral pattern to predict the likelihood that a borrower will default a loan. This helps the lender to make better decisions, reduce risk, and manage the credit portfolio more effectively. What is default prediction? Default prediction involves using AI and machine learning model to forecast the likelihood that a borrower will fail to repay a loan on time. How AI predicts defaults? AI data collection uses financial data, credit history, transaction record employment status, and sometimes alternative data, for example, social behavior. Feature engineering extract the important variable like payment history, debt to income ratio, and credit utilization. Model training is training models like logistic regression, random forest, gradient boosting machine, GBM, neural network, or historical borrower data. Prediction and scoring produces a profitability score indicating the risk of default and helping the lenders make informed decisions. Continuous learning. AI model update and improve the overtime as a new data comes in. Benefit it accurate risk assessment, faster credit decision, reduces the non-performing loans, and supports the proactive portfolio management. Challenges: data privacy and scrutiny, model-based and fairness issues, requires large and high-quality data sets, regulatory compliance. For example, banks and fintech companies use AI-powered default prediction model to approve the loans and set interest rates accordingly. The next is AI in microfinance. AI helps microfinance institutions access the creditworthiness of low-income borrowers by analyzing the alternative data, automating loan approval, and reducing risk. It enables a faster, more inclusive lending, improves the financial access, and lower the operational cost. What is microfinance? Microfinance provides a financial service like small loans, savings, and insurance to the low-income individual or a group typically excluded from the traditional banking. How AI in transforming microfinance, credit scoring for the unbanked, AI analyze the alternative data, mobile usage, social media, transaction history to access the credit worthiness without traditional collateral or credit history. Loan application automation. AI-powered platforms streamline the application processing and approvals, reducing the paperwork and manual intervention. The fraud detection. AI model detects the fraud activity and ensures the integrity of transactions. Risk assessment and management. AI predicts the loan repayment likelihood, helping the reduce the default and improve the portfolio quality. Personalized financial products. Tailored products are repayment and schedule based on the behavior and needs. Customer support automation. Chatbot and virtual assistant provide 24 by 7 services, improving the engagement and financial literacy. Benefits: it increases the access to credit for unserved population, enhance the efficiency and reduces the operational cost, improves the risk management and reduces the default, enables a personalized and inclusive the financial services. Challenges: data privacy and ethical concern, limited data and availability at quality in rural areas, need for digital literacy amongst the borrower, and infrastructure and connectivity issues. The AI in microfinance enables the better credit assessment, fraud detection, and personalized product delivery using data-driven insight. It emphasizes how AI helps to bridge the financial inclusion gap by overcoming the traditional barriers. The next is AI in debt recovery. Let's see the introduction. Debt recovery is a critical function of financial institutions, lenders, and services provider to manage the overdue payment efficiently. Traditional debt recovery methods are often manual, time-consuming, and can negatively impact the customer relationship. AI revolutionized the domain by automating the processes, improving the efficiency, and enabling the smarter decision making. Key application of AI in debt recovery is automated customer interaction. The chatbot and virtual assistants. AI-powered chatbot can handle the customer queries 24/7, negotiate the payment plans, and send the reminder via SMS, email, or voice calls without human intervention. Natural language processing enables the chatbot to understand the customer intent and respond empathically and improving the engagement. B is predictive analysis. Uh, AI model analyze the historical payment behavior, credit score, and external data to predict which customer are likely to default. This helps the prioritize the recovery efforts and on account with the higher chance of successful collection, optimizing the resource allocation. Personalized payment plan. AI designed the personalized repayment plan based on the customer financial data and past behavior. This increases the likelihood for of the payment by aligning the plans with the debtor's capacity. Risk scoring and segmentation. AI classifies the debt data based on the risk profile, segmenting them into categories, for example, high risk, low risk. Enables the trainer recovery strategies such as gentle reminder for low risk or legal action for high risk cases. Sentiment analysis. AI analyzes the AI customer communication to gauge the sentiment and emotional state. As agent to adjust the approach and improving the chance of recovering well while maintaining the good customer relation. Automation of routine tasks. AI automates the routine tasks like sending reminders, scheduling call, and updating the payment statuses. And it reduces the human intervention and operational cost. Fraud detection. AI can detect the suspicious activity or false claim in the debt descriptive, preventing fraudulent cases. Benefit of AI in debt recovery. AI highly recovery rates, Targeted strategies and timely interaction increases the collection successes. Cost efficiency automates the and reduces the manpower and the cost and operational overhead. Improve the customer experience, which is personalized communication and empathic interaction prevents a negative customer experience. Faster recovery cycle, AI speeds up the identification and resolution of overdue accounts. Data driven insight, continuous learning from the data has to define the strategies and over time. Challenges at consideration is data privacy, handling sensitive in financial personal data requires strict compliance with regulation, for example, GDPR and CCPA. Ethical concern, AI must avoid discriminatory practices and ensure the fairness in collection method. Integrating complexity, a legacy system may need upgrades to the fully leverage AI capabilities. Customer trust, transparency about AI rules in debt recovery helps to maintain the trust. For example, AI tools in debt recovery is AI powered CRM systems, integrate AI to automate the workflow and communication. Predictive dialers for the call as a data and optimal times identified by AI. Voice bots conduct the interactive calls to negotiate payment. Machine learning platform continuous improve by scoring and recovery strategy. Future trends is uses of advanced NLP, more human-like conversation for better engagement, integration for digital payment, immediate payment solution during the recovery call, real-time credit monitoring, proactively alert for the customers approaching risk, and cross-channel interaction, seamless communication across SMS, email, and voice and apps. The next is ethical concern in AI, in credit AI. AI in credit decision and unintentionally cause bias and discrimination, affecting fairness in lending. The risk of lack of transparency, privacy issues, and accountability challenges ensures the explainability, data ethics, and regulatory compliance is crucial to build the trust and fairness in AI-driven credit systems. Biases and discrimination problem is the AI model can unintentionally learn and simplify the biases present in the historical data. For example, in past lending data shows the bias against a certain group based on the race, gender, age, or geography. AI may replicate the worsen these biases. Impact certain demographic might be unfairly denied credit or charge higher interest rate, leading to the systematic discrimination. Mitigation use buyer detection for fairness aware algorithm, regulatory audit model, and data sets include the diverse data sources. The second is transparency and explainability. The problem is many AI credit models, especially those complex machine learning techniques, for example, deep learning, act as a black box decision making processes and not easily understandable. The impact of these customers are and regulators may not know why credit application was denied, which was undermine trust and accountability. Mitigation develop the explainable AI XAI techniques to provide these clear results for credit decision and provide the customer with the understandable explanation. Privacy and data protection problem. Credit AI requires an extensive personal and financial data, raising the concern about how the data is collected, stored, and shared. Impact unauthorized access. The data breach is misuse of sensitive information can harm the individual. Mitigation comply with the data protection like GDPR, CCPA, implement the strong security protocols, and minimize the data collection and only in what necessary. Consent and control. The problem of the customer may not be fully aware that the AI is being used to access the credit worthiness or may not consent to the AI all the data uses. Impact this this can violate the individual right to reduce the ability to control the person information. Mitigation. Ensure the transparent data collection policy, obtain explicit information, informed consent, and allow the user to opt for out or collect the data. Fairness in lending. AI may unintentionally favor and favor the certain group or region due to biased data or flawed modeling. Impact this can deepen financial exclusion for vulnerable population. Mitigation uses fairness constraint in model training, promotes the inclusive lending policy, regular monitors outcomes, and disparate the impact. Accountability. When AI makes an erroneous credit decision, it can be unclear who is responsible, the lender, the AI developer, or the data provider. Impact. The lack of the clear accountability can harm the customer and reduce the confidence in AI. Mitigation. Establish clear governance framework defining the roles and responsibility, maintaining the audit trial for AI decisions. Over reliance and on automation. Fully automated credit decision may overlook the contextual factors that a human loan officer might consider. This could lead to unfair denials and missed opportunity to support deserving applicants. Use hybrid approach, combining AI insight with the human judgment and implement the override mechanism. Unintended consequences. Problem. AI model might optimize for the profit or efficiency by ignore the social or ethical consideration. Impact could reinforce the existing inequality or create a new systematic risk. Mitigation. Incorporate with the ethical framework and stakeholder input in AI development and conduct the impact assessment. The next is regulatory landscape for AI. Regulatory, ethical, and security aspects and regulatory landscape for AI. The regulatory landscape for AI involves the law, guidance, and standard designed to ensure the AI systems are safe, ethical, transparent, and fair. Government and regulators focus on the data privacy, bias prevention, and accountability, and compliance to the protect the user and maintain the trust in AI technology, especially in sensitive AI like finance. Let's see the overview. As AI technology become the widespread across the industry from finance and healthcare to transportation and defense, governments and regulatory bodies worldwide are developing a framework to ensure it's used responsibly, ethically, and unsecurely. And the regulatory and landscape is evolving to address the risks such as bias, privacy violations, lack of transparency, and cyber security threats. Key regulatory objective of AI is safety and security, ensures the AI system operates safely without causing harm to individual or society. Fairness and non-discrimination prevent the AI with perpetuating the biases or discrimination. Transparency and accountability mandate the explainability and assign the responsibility for AI decision. And privacy protection regulate the data collection, processing, and storage to protect the individual personal information. Ethical use promote AI application aligned with the social values and human rights. Robustness it ensures the AI system are resistant to attack and operate reliable under a various conditions. The three major AI regulatory framework and guidelines are a European Union, which is AI Act proposed, which classifies the AI systems by risk and unacceptable, high and unlimited and minimal, which bans the certain human AI uses, for example, social scoring by government, real-time biometric surveillance in public. And second is GDPR, which is General Data Protection Regulation, governs the personal data used in AI systems, include the rights such as data access, correlation, and automated decision explanation. United States, which is AI, initiates a guide and guidelines. No comprehensive AI law yet emphasize on sector-specific regulation, for example, FTC or unfair practices. National AI Intensive Act promotes the research on responsible AI development. An Algorithmic Accountability Act proposed requires an impact assessment for automated decision systems. China, it is strong AI development policy coupled with the high security oversight guidelines emphasize the AI ethics and security and social stability, focus on the control of the algorithm, particularly in finance and social media. International organization OECD AI application promotes the inclusive in growth, human rights, transparency, and accountability. UNESCO recommendation on AI ethics framework for ethical AI respecting AI human dignity and rights. ISO IEC standards, technical standard for AI systems management, robustness, and transparency. Ethical guidelines in regulation, human-centric AI. AI should augment human ability and respect human autonomy, non-maleficence, justice and fairness, accountability, explainability, and data privacy and data governance. Security and consideration with the data security, model security, operation security, and supply chain security. Challenging in regulation is rapid technological growth, global coordination, balancing innovation and control, enforcement, defining liability. For example, is the financial institution may comply with the AI transparency and fairness to avoid discriminatory lending. Healthcare AI systems health requires the approval to ensure the patient safety and data privacy, and automates the autonomous vehicle and safe space safety certification and liability rules. So now let's take 5 minutes break. protecting the personal and sensitive information used by the AI. It ensures that the AI model handles the data securely, comply with the regulations like GDPR, and prevent the unauthorized access or misuse of user data. Privacy preserving and techniques like anomalization and encryption are used to maintain the trust and comply with the legal standards. This is the introduction. Introduction says it artificial intelligence system rely on heavily on vast amounts of data, often including sensitive personal information. Data privacy concern arises because of AI can collect, process, and analyze and infer the information about the individual, sometimes beyond what can initially intend or consent to. The key data privacy concerns in AI are data collection and consent. AI systems often requires a larger data set which may include the personal and sensitive information. Data minimization collection only that the data necessary for AI purpose and helps to reduce the privacy risk. Over collection increases exposure to breach the misuse. Data anonymization and de-identification. To protect the privacy, data can be anonymized and de-identified. Data scrutiny, storing and processing larger datasets make AI systems a target for cyber attacks, and breach can expose the sensitive personal information. Purpose limitation, data should be used only for the purpose for which the consent was given. Repurposing data without consent violates the privacy principle. Transparency and user control. Users should be informed about what data is collected, how it is used, and how who has the access. Profiling and automated decision making. AI may profile the users or make an automated decision affecting them, for example, credit scoring. Challenges in protecting the data privacy with AI is complex data inflow, which AI often integrates the data from various sources and complicating the data governance. Dynamic learning models. AI model continuously learn and update the potential, creating new privacy risks. Difficulty in explaining AI use of data, cross-border data transfers, and balancing the utility and privacy. Regulatory framework related to AI and data privacy is GDPR EU. Strict rules on personal data processing, consent, data subject rights, and the rights to explanation for automated decisions. Data protection impacts the assessment and the DPIA required for a high risk AI systems. CCPA, California, is the consumer right to access and delete and opt out to data sales. Other law, Brazil's LGPD, India's proposed personal data protection bill, etc. Best practices for ensuring data privacy in AI is privacy by design, data governance, data minimization, anonymized techniques, and consent management. Explainability and transparency, and regular audit and assessment. Emerging technology for privacy protection is federated learning, differential privacy, homophobic encryption, and secure multi-party computation. Conclusion: the data privacy is a fundamental aspect that must be addressed in AI development and deployment. Respecting privacy builds trust, it ensures the regulatory compliance, and promotes the ethical AI usage. The next is GDPR compliance in finance. The GDPR compliance in finance ensures that the financial institution protect the personal data of customer according to the European Union's General Data Protection Regulation, which is GDPR. It requires the banks and financial firms to obtain a clear consent, securely process data, provide data access right, and report and breach and promptly. Compliance helps to maintain the customer trust and avoid heavy fines. Introduction to GDPR. The GDPR, the General Data Protection Regulation, is an EU regulation effective since May 25, 2018. It governs the processing of the personal data of EU residents and aims to protect the individual privacy and data rights. Financial institutes deal with the vast amount of sensitive personal and financial data, making GDPR compliance critical. The key GDPR principle relevant to the finance is lawful and fairness transparency, with data must be proceed legally, fairly, and transparently with a clearly disclosure on data use, no hidden processing. Purpose limitation of a specified legitimate purpose used for the authorized financial services. Data minimization, only collected data necessary for the purpose and avoid the excess data collection beyond what's needed. Accuracy, keep the personal data accurate, up to date, regular update to the customer record. Storage limitation, data only as long as necessary. Data defined detention period and securely delete the data. Integrity and confidentiality, protect the data against the unauthorized access or breach. Strong cybersecurity encryptions, access control. Accountability, demonstrate the compliance with GDPR and maintain the record, conduct audit, appoint the data protection officer, DPO. Specific GDPR requirement for financial institution is legal by basis for processing, consent management, data subject rights, automated decision making and profiling, data breach notification and data protection impact assessment DPIA, and data protection officer, which is DPO. The challenges for financial institution is legal systems, complex data flows, balancing compliance and innovation, and employee training. The best practices of GDPR compliance in finance is implementing the privacy by design, maintaining a clear documentation, use the encryption and anonymization, regular audit and monitoring, vendor management, and customer communication. The consequences of non-compliance will be defined up to the euro 20 million euro or 4% of annual global turnover, which is very higher, reputational damage and loss of customer trust, legal action and restriction on data processing activity. Next is bias in AI algorithm. Bias in AI algorithm occurs when the data or design cause unfair or inaccurate outcomes, often reflecting existing prejudice. In finance, biased AI can lead to the discrimination in credit decision lending or risk assessment. Addressing biases in critical or ensures the fairness, transparency, and trust in AI-driven financial systems. What is bias in AI? Bias in AI refers to systematic and unfair discrimination embedded to outcomes or behavior of the AI systems. It occurs when the AI algorithm produces the prejudiced result and with the prejudiced assumption or data and leading to the unfair treatment or uncertain individual or group. How does the bias arise in the AI algorithm? Is bias in training data. A AI model learns from the historical data. If the data contains biased human decision or reflect the social inequalities, the AI will learn and perpetuate those biases. For example, under representation of minorities in data set, bias, don't approval record, etc. Sampling biases when the training data set does not accurately represent the total population, causing of the AI to perform poorly for unrepresented groups. Label bias in unsupervised learning, bias labels, human or annotation or categorizing can be misguide the model. Algorithmic design bias. Choices is model design, feature selection, and uh, parameter tuning may unintentionally favor the certain outcomes. Feedback loops. AI decision influence the future data. For example, denying the loans to the group means less data on the data repayment behavior, reinforcing the biases over time. Types of biases is historical biases, sampling biases, measurement biases, algorithmic biases, and confirmation biases. The impact of bias in AI is discrimination, loss of trust, legal and regulatory risk, and perpetuation of inequality. Detection biases in AI is statistical party test, disparate impact analysis, fairness and metrics, and audit. Mitigation biases in AI algorithms is diverse and representative data collection, data processing, algorithmic fairness, fairness technique, transparency and explainability, human in the loop, continuous monitoring. Ethical and legal consideration is compliance with anti-discrimination law, for example, Equal Credit Opportunity Act, GDPR, upholding the ethical principle of fairness, justice, and respect for individuals. The next is explainable AI, XAI. What is explainable AI? Explainable AI refers to the AI systems that designed to provide the clear, understandable explanation for the decision and action. In finance, XAI helps to build the trust by making complex AI model transparent, allowing the user and regulator to understand how the decision can, like loan approvals or risk assessment, are made. The why is explainable AI important, which is it is trust and adoption. User can and stakeholder are more likely to trust an AI system whose decision that can be understand. Regulatory compliance laws like GDPR requires the explanation for automated decisions affecting the individual. Debugging and improvement. Developers can diagnose and improve the AI models by understanding their behavior. Ethical accountability. Explainable decision helps to identify and mitigate the biases or unfair practice. Safety and reliability. Clear explanation reduce the risk in a critical application like healthcare, finance, and autonomous vehicles. Types of explainability is global explainability and local explainability. Exercise techniques and method is model agnostic method can be applied to any AI model. For example, line which is local interpretable model agnostic explanation and sharp which is sharply additive and explanation. Interpretable models inherently understand due to the simple structure, decision tree, linear regression, rule-based models. Visualization tools, for example, feature importance plot, partial dependence plot. Factual explanation, for example, if your income were $5,000 higher, your loan would be approved. Challenges in explainable AI is complexity and interpretive trade-off, under user understanding, standardization, risk of oversimplification. Application of explainable AI is finance, health, healthcare, legal, and autonomous systems. The next is AI for compliance automation. The compliance automation uses AI-powered tool to help the organization adhere the law, regulation, and internal policy efficiently and accurately. Given the complexity and volume of the regulatory requirement, AI reduces the manual effort, error, and cost by enhancing the oversight. The key areas where the AI automate the compliance is regulatory monitoring. Is the AI continuous scans the regulatory update from the government bodies, industry and association, and news resources. Documented or document analysis and reviews is the AI analyze the contract policy and other legal document to identify the compliance risk, inconsistency, or missing costs. Transaction monitoring. AI in finance, AI system detects the suspicious transaction that may indicate fraud, money laundering, and sensation violation. Automated reporting. AI automate the data gathering, validation, and report generation required for regulatory submission. Risk assessment and management. AI model predict the compliance risk level based on the historical data and real-time input. Enables the proactive mitigation and resources allocation. Policy management. AI tools help to create and update and distribute the compliance policy within the organization. Benefit of AI in compliance automation is efficiency, accuracy, cost reduction, real-time insight, scalability, and enhance the risk management. Example of AI technology used is natural language processing, machine learning and robotic process automation and computer vision, chatbot and virtual assistant. Challenges and consideration, data quality, integration, regulatory acceptance, ethical use and security. cybersecurity. Cases by industry is financial industry, which is anti-money laundering detection, fraud prevention, KYC, know your customer automation. Healthcare, which is HIPPA compliance, billing audit, clinical trial monitoring. Manufacturing is environmental and safety regulation compliance. Retail is consumer protection law, supply chain transparency. Future trends is increased use in AI-powered regulatory sandboxes for testing compliance tools and developing for of explainable AI to enhance the regulatory trust. The next is AI and financial cybersecurity. Financial security, a financial institution are prime target for cyber attacks due to the sensitive nature of financial data and potential for monetary gain. Artificial intelligence enhance the cyber security by enabling the proactive, adaptive, and intelligent defense mechanism to detect, the prevent, and respond to the cyber threat in real time. Key application of AI in financial cybersecurity, threat and detection prevention. AI systems analyze the network traffic and user behavior to identify the unusual pattern indicating the cyber threat, for example, malware, phishing, and fraud detection. AI monitor transaction in real time to flag the fraudulent activities using the anomaly detection and pattern recognition. User authentication is access control. AI supports biometric authentication. It is face recognition, fingerprint, or voice. At incident response and automation, AI powered security, orchestration, orchestration, automation, and responses is SOAR tools automatically investigate and respond to threats, speeding up and mitigation. Vulnerability management, AI scan code and system for security vulnerability and prioritize the patching based on the risk. Phishing and spam filtering, natural processing language detects the phishing emails and malicious content. Benefit of AI in financial security, cybersecurity is real-time monitoring, constrain the violations and rapid detection and response, adaptability, scalability, reduces the false positives, cost efficiency. Challenges and consideration, which is data privacy, adversely attacks, model explainability, integration complexity, resource requirement. Example of AI technique used is machine learning, deep learning, natural language processing, reinforcement learning, and behavioral analytics. Emerging trends is explainable AI and cybersecurity, AI-driven threat in intelligence sharing, integration by with blockchain, use of AI in cloud security. Integration of blockchain in AI. Blockchain and artificial intelligence are two transformative technologies shaping the future of industry. While the AI focuses on the data-driven decision making and automation, blockchain provides a decentralized, secure, and transparent data storage. Integrating this technology allows a new possibility by combining AI intelligence with the blockchain's trustworthiness. Why integrate blockchain and AI? Data integrated for AI Data integrity for AI is blockchain immutable ledger ensures the AI model uses the tamper-proof variable data and enhancing the AI reliability. Decentralized AI blockchain can facilitate the decentralized AI marketplaces and distribute the model training without relying on centralized authorities. Enhance security, transparent AI decision, and data privacy. Uses case of blockchain and integration in supply chain management, healthcare, finance, decentralized AI marketplace, IoT networks, and identity management. Technical integration approaches, the data provenance and verification, smart contracts, federal learning, and blockchain incentive mechanism. Benefit of integrating blockchain and AI is it improves the data quality, enhances security, has a transparency and auditability, have a increased centralization, and have privacy preservation. Challenges were scalability, complexity, regulatory uncertainty, and energy consumption. Let's see the future output. Look is the development of blockchain-based AI governance framework to ensure ethical AI, expansion of decentralized AI platform, advance in privacy preserving AI using blockchain, and enable the cryptographic technique, greater use for smart contracts. The next is dependency risk. What is dependency risk? Dependency risk refers to the vulnerability and potential negative impact that arise when a system, project, or organization relies heavily on the external or internal dependency. Those dependency can only be on software, hardware, vendors, data sources, technologies, and other third-party services. Types of dependency risk are vendor dependency, technology dependency, data dependency, process dependency, skill dependency, and infrastructure dependency. This associated with dependencies is operational disruption, security vulnerabilities, cost increase, cost or loss of control, and data quality issues, and knowledge silicon. Dependency risk in AI and technology is model performance risk, third-party API risk, open source component risk, and cloud provider risk. Mitigation and strategy. The strategies is diversification, vendor management, documentation and knowledge sharing, contingency planning, regular audit and review, and use of standards and open technology, automated monitoring. The conclusion is the dependency risks are an inherent part of a modern technology and businesses ecosystem. Identifying, the understanding, and managing this dependency proactively, which ensures the operational resilience and security and business continuity. The next is model risk in AI. What is model risk? Model risk refers to the potential for adverse outcome of financial loss resulting from error, inaccuracies, or misuse of AI models. It arises when the AI model produces incorrect biases or unreliable output that lead to the poor decision or operational failure. Sources of AI modern risk in AI is data quality issues, which is poor, incomplete, outdated, or biased training data. For example, AI credit scoring model training on biased historical data, model design incorrect assumptions, overfitting of unfitting the data, leading to the inaccurate predictions, flaws, um, implementation error, coding mistakes, by bugs in model deployment causing faulty results, changing environment, model not be adapting to new market conditions, fraud detection model failing or fraud tactics involved, inadequate validation, insufficient testing, back testing, stress testing, deploys or models without robust performance or evaluation, misuse or models is intended scope of without expert oversight, and unrelated customer segment, lack of explainability, inability to understand or justify model decision, black box AI model making critical decision without transparency. Impact of model risk is financial loss, regulatory penalties, reputation damage, operational disruption, and ethical and legal risk. Model risk and management in AI is governance framework. It established a policy and procedure for models, developing validation, deployment, and monitoring. Model validation and testing performs the rigorous testing, includes the web testing, stress testing, and sensitive analysis. Data management ensures the data quality, relevance, and representativeness. Explainability and transparency uses explainable AI techniques to clarify model decisions. Continuous monitoring tracks the model performance in production to detect the degradation of anomalies. So audit and compliance maintain the audit trials of the model changes and decisions. Human oversight incorporate the expert judgment in interpreting the model output. Tools and technique is explainability tools, which is line, sharp for interpreting models. Validation software is automated testing framework, performance monitoring dashboard, tracking like key metrics like accuracy, bias, and drift. Risk assessment matrix, which is to prioritize the model based on the impact and complexity. The next is AI's impact on financial stability. Artificial intelligence is transforming financial system globally by enhancing efficiency, decision making, and innovation. While AI offers many benefits from financial stability, it also introduces new challenges and risks that regulate the institute and policymaker must address. Positive impact of AI in financial stability is improved risk management. AI enables advanced risk assessment by analyzing the larger volume of adverse data in real time, enhanced fraud detection and cybersecurity. AI-powered system detects and prevents the fraud, cyber attack, and financial crimes rapidly. Increased market efficiency. AI algorithm improves the price discovery, liquidity management, and trade execution. Better regulatory compliance. AI automates the regulatory reporting and monitoring, involving the compliance and in reducing the operational risk. Financial inclusion. AI-driven credit scoring and personalized financial product expand access to the banking for unserved population. Potential risks and challenges to financial stability. Model risk and over reliance. Heavy dependence on AI model can amplify the systematic risk if models fail to proceed in accurate prediction. Operational risk. AI system can be vulnerable to the technical failure, cyber attack, or manipulation like adversarial attacks. Data privacy and security concern. AI requires vast data sets, rising the risk of data breach or market manipulation and ethical issue. AI-powered high-frequency trading can lead to the flash crashes or market manipulation. Regulatory and supervisory challenges. Regulatory may struggle to keep the pace with the AI innovation and adequately supervise AI-driven activity. For example, AI impact of financial stability is the positive impact is AI detecting early warning signals for credit default, and the risk factor is AI-driven hardened behavior causing market shock. And the positive impact is expanding the financial access to AI-powered credit, and the risk factor is potential bias is an AI lending decision. Regulatory and industry responses is development of AI in governance, stress testing AI model, collaboration and information sharing, promoting explainability, cybersecurity enhancement. So the next is about the case study on global perception, per, per, perceptive and AI adoption in US financial sector. So let's see the overview of AI adoption in US financial sector. The US financial industry is a global leader in AI adoption, leveraging AI for risk management, customer services, fraud detection, and investment management. Major bank, fintech, startup, and regulatory bodies actively explore AI to enhance its efficiency and competitiveness. AI investment in US finance are among the highest worldwide, driven by the data availability, talent, and regulatory innovation. Case study is the JP Morgan Chase Point platform with application is contract intelligence uses AI to review the legal document and extract the critical data. The impact is reduces the document review time from 3,60,000 hours annually to seconds, and significantly cutting the operation costs and errors. Significance is demonstrate AI ability to automate the complex and legal compliance tasks. A Bank of America Erica virtual assistant application AI powered chatbot that helps the customer with the transaction bill payment and financial advice impact over 30 million users, improving the customer engagement and reducing the call center volumes. Significance illustrate AI potential in customer service and personalization. PayPal fraud detection application AI system analyze the transaction pattern to detect and prevent the fraud in real time. Impact is reduction in fraud losses and enhance the customer trust. Significance highlights AI critical role in cybersecurity and fraud detection. The global perspective is the region in USA, Europe, Asia, in China and India, Middle East and Africa. The USA AI adoption focuses in financing AI risk in management and trading, the customer service and fraud detection. Which is notable trends is heavy investment in AI R&D, regulatory support, fintech innovation in Asian, China, and India, mobile payment, credit scoring, microfinance, blockchain, AI integration, and rapid fintech growth and digital inclusion, government-led and AI strategy. Regulatory and industry initiatives in USA's Federal Reserve and OCC, FinCEN, industry consortia, ethical guidelines. Challenges faced by US financial sector is ensuring AI model explainability, managing biases and fairness, addressing cybersecurity threats, and balancing innovation with compliance. Future outlook is increased use of explainable AI and human in loop approaches and enhance the AI-driven financial inclusion through personalized product and services. So the next is Europe AI trends in banking. The overview is Europe banking sector is embracing AI with strong focuses on regulatory compliance, ethical AI, customer experience, and operational efficiency. Banks are investing heavily in AI technology by navigating strict data privacy like laws like GDPR. Key AI trends in European banking is regulatory compliance and risk management. AI-driven solution helps the bank comply with the regulations such as GDPR, PSD2, and anti-money laundering directives. Explainable and ethical AI is strong emphasis on developing transparent and explainable AI model to meet the regulatory requirements. Customer experience and personalization, AI-powered chatbot and virtual assistant for 24/7 customer support. For example, BBVA as AI assistant. Fraud detection and cybersecurity, advanced AI algorithm to detect and prevent the fraud, phishing, and cyber threats. Process automation and efficiency. Process automation combined with the AI for detecting, automating the back office tasks such as loan processing, KYC, and compliance checks. For example, of AI adoption in European banks is BBVA within Spain, ING in Netherlands, Standard in UK and Spain, etc. Regulatory environment impacting AI in banking is GDPR, European Banking Authority (EPA) and AI Act which is proposed. Challenges is balancing innovation and compliance, ensuring data privacy, addressing AI biases, and integrating AI with legal banking systems. Future outlook is growth of explainable AI, XAI adoption to enhance the trust and regulatory acceptance, and continue the collaboration between banks and regulatory and tech firms to create a responsible AI ecosystem. Next is in India's fintech landscape. India's fintech sector is one of the fastest growing in the world, driven by the widespread smartphone adoption, increasing the internet penetration, government initiatives, and large unbanked population. The sector is transforming traditionally and financial services by improving the accessibility, affordability, and convenience. Key driver of Indian fintech growth is Digital Indian initiative, and unified payment interface uses UPI, Aadhaar, large young population, smartphone penetration. Major segment and technologies is digital payment, lending, and unstructured tech, wealth tech, reg tech, and neobanking. Key players in India fintech ecosystem is payment, which is Phone Pay, Google Pay, Paytm, Razor Pay. They are digital wallet and UPI-based payment platform, leading lending to the lending card, capital float, early salary. Uninsured tech is Policy Bazaar, digital insurance, wealth management is Zerodha, Zerodha growth of stocks, new banking is Neo, Open, Jupiter, RegTech is Sangreen, cashless, ECA software. Government and regulatory support is Reserve Bank of India, RBI, Security and Exchange Board of India, SEBI, Insurance Regulatory and Development Authority of India, IRDAI, Data Protection Bill. Challenges in India fintech is financial literacy, data privacy and security, infrastructure gaps, regulatory complexity, trust and adoption. Future trends is AI and machine learning adoption, blockchain integration, embedded finance, and expansion into tier 2 or 3 cities and sustainable finance. China's AI fintech integration. The overview is China is rapidly emerging as a global leader in integrated artificial intelligence with finance, leveraging its massive data ecosystem, advanced AI research, and strong government support. China's financial sector is innovating aggressively across payment, credit and wealth management, risk control, and more. Key driven is massive data availability, government support, fintech innovation, regulatory evolution. Major AI app in China is China's financial sector is credit scoring, fraud detection and security, wealth management and robo advisor, uh, customer service, risk management and compliance, payment and digital currency. In credit scoring, the application is for example, and company season credit, fraud detection and security, ping and technology, wealth management and robo advisory, Lufax, customer services, ping and good doctors, AS assistance, risk management and compliance is sense time, U2 technology, uh, payment and digital currency is Alipay, WeChat Pay, digital yuan, notable Chinese fintech and AI leaders is Ant Group, Alibaba, Tencent, Ping A and Insurance, Baidu, SenseTime in Vietnam. Regulatory environment, the People's Bank of China, PBOC, is a plotting and digital yuan ECYN, integrating AI for transaction monitoring and fraud prevention. And regulatory focuses on the balancing the innovation and financial stability, data security, and consumer protection. Recent crackdown on fintech giants have increased scrutiny on the data privacy, monopolistic practices, and AI transparency. Challenges is data privacy concern, AI bias and fairness, regulatory uncertainty, technology integration, and international competition. Future outlook is expansion of AI regulated technology, RegTech, and integration of AI with blockchain, development of ethical and AI framework, wider adoption of digital currency, and cross-border AI finance collaboration. Next is startup revolutionizing finance. Introduction, fintech startups are transforming finance by leveraging technologies like AI, blockchain, big data, and cloud computing to create a new business models, enhance the customer experience, and improve the operational efficiency. The key area of innovation is digital payment, lending and credit, wealth tech, insurtech and regtech, and new banking, blockchain and crypto, and personal finance management. Digital payment is Stripe Square, Razorpay. Lending and credit is Lending Key Club, Upstart, and Capital Float. Wealth tech is Betterment, Wealthfront and Grow. InsurTech is Lemonade, Policy Bazaar, Root Insurance. RegTech is Comply Advantage. Um, Neo Banking is Team, N26. Blockchain is Coinbase, Chain Analysis, Ripple, and personal finance management is Mint and Walnut. The notable fintech startup by region is USA startup is Stripe, Robinhood, Lemonade, which focus area is payment, investment, and insurance. Europe is Revolt and TransferWise is Wise, which is main focus is neo banking and cross border payment. In India, it has a Razorpay and Policy Bazaar, which payments are lending, UPI based and SME lending, Policy Bazaar, InsurTech, online insurance marketplace. China is Ant Group is payment credit insurance, and Lufex is wealth management. Technology driving startup innovation is artificial intelligence, blockchain, cloud computing, big data analytics, and APIs. Impact of traditional finance is disrupting financial inclusion and cost effective efficiency and innovation acceleration. Challenges in fintech startup is regulatory compliance, by building customer trust, competitive from establishing a financial institute, managing the cyber security and data privacy, scaling the sustainability by valuing maintaining innovation. So the next is leading in AI fintech company. So an AI fintech company uses the advanced technology such as machine learning, language processing, and predictive analysis to automate the processes, involve the decision making, enhance the customer experience, and strengthen the risk management in finance. Top AI fintech companies are Group, which is in China, Upstart in USA, Zest in AI USA, Kabaj American Express in USA, Kensho S&P Global USA, and Trace UK, and Noodle AI in USA, Cello I UK, and Bearex in USA and UK. Key application in fintech is credit scoring and lending. For example, companies is Upstart. Fraud detection and security is Behavior. Customer service chatbot is LOAI, and market analysis and trading is Kensho and Numeria. RegTech and compliance is Behavior and Comply Advantage. Personal finance management is LOAI and Yacht. Emerging AI fintech leaders is Traceability, ThoughtSpot, Oracles, and Educa 8. Global impact is increasing, leading to unserved market using AI scoring, credit scoring, and greater regulatory compliance and risk mitigation. PayPal AI for fraud prevention is PayPal is one of the largest online payment platforms leverage the artificial intelligence extensively to detect the prevent and reduce the fraud and protecting millions of users and billions of transactions globally every year. How PayPal uses AI for fraud detection is AI, real-time transaction monitoring. AI model analyze millions of transactions per second in real time, and detect the suspicious patterns such as unusual spending behavior, location anomalies, or the devices inconsistency. Machine learning algorithm. PayPal uses the supervised and unsupervised machine learning model trained on vast historical transaction data. Behavioral analytics. AI analyzes the human behavior over time and create two unique profiles. Network analysis. The AI examines between the account and device IP address and transaction. Risk scoring. Each transaction is assigned a dynamic risk score based on the multiple AI analyze factors. Adaptive rules and engine. AI works alongside and the rule-based system that updates it dynamically. Benefit of AI-driven fraud prevention at PayPal is high detection accuracy, scalability, continuous learning, improved customer experience, and reduce the financial losses. Challenges and mitigations involving fraud tactics, data privacy, balancing security, and user convenience. Future direction is integration of AI, enable AI, and you increase the use of biometric authentication by powered by AI. The next is Square credit modeling. The Square, now known as Block, is leading the financial technology company offering payment processing and small business lending services. Square Capital, its lending arm, uses the advanced credit monitoring powered by AI and machine learning to improve the fast, accessible loans to small and medium-sized business (MPS). How Square uses AI credit modeling is alternative resource data sources, machine learning algorithms, real-time decision making, dynamic loan offers. The benefit of Square credit modeling is increased financial inclusion, faster loan approval, reduced risk, tailoring financial. Challenges and consideration is data privacy and security, uh, and model bias, regulatory compliance, economic volatility. Future direction is the integration of more granular and alternative data such as social media or supplier information, use of explainable AI to enhance transparency in decision making, expansion into a new market with localized credit modeling approaches. The next is Zest Finance AI platform, or Zest Finance company, commonly known as Zest AI, is a leading fintech company specialized in AI-driven credit underwriting solution. Platforms help the lenders to make a better, faster, and fairer credit decision by leveraging machine learning and big data analytics. The key feature of this Finance AI platform is machine learning powered underwriting, fairness and bias mitigation, explainable AI XAI, easy integration, benefit of using Zest Finance and AI platform. The benefits are improved credit access, high predictive accuracy, regulatory compliance, fast decision making, and continuous learning. Uses cases is consumer lending, personal loan, credit card, auto loan, small business lending in evaluating the creditworthiness or SPMS using diverse data source, mortgage lending, improving risk and assessment for home loans, financial inclusion initiatives. Industry impact is suggests AI helps the numerous lenders increase their approval rates by lowering their default rates. The platform recognized is combining the cut-edge AI with strong ethics and compliance focus. The next is Mastercard Decision Intelligence. The Mastercard Decision Intelligence is an advanced AI-powered fraud detection and risk management platform designed to help the banks, merchants, and payment processor identify and prevent a fraudulent transaction in real time by minimizing the friction for legitimate customers. Key features is AI and machine learning, real-time transaction scoring, global data network, explainable AI, flexible integration. Benefits is reduce the fraud losses, improve the approval rate, enhance the customer experience, scalability, and regulatory compliance. Uses cases is issuer bank uses the decision intelligence to protect the cardholder from the fraudulent charges. Merchant e-commerce platform uses it to secure the online payment. Payment processor is integrated to ensure the secure and reliable payment. Digital wallet enhance the security for mobile and contactless payment. The future direction is expansion into an AI-driven verification and biometric authentication and enhancing the collaboration with the legal regulators and industry patterns to fight and involving the fraud. The next is Lemonade AI in insurance. Lemonade is a lending insure tech company that uses artificial intelligence to describe the traditional insurance models by providing fast, transparent, and customer-friendly insurance services, primarily in rentless homeowners and pet insurance. How Lemonade AI uses AI is AI-powered chatbot is Maya, automated underwriting claims processing with AI gym, fraud detection. Benefit of Lemonade AI approach is speed and convenience, transparency, cost efficiency, customer experience, fraud reduction. Impact on insurance industry is Lemonade has a popularized AI-driven insurance setting new standard for digital first customer engagement, demonstrate the potential of AI to make insurance more accessible and affordable. Future direction is expanding the insurance product offering using AI insights and exploring AI integration in broader insurance company ecosystem, including reinsurance and underwriting. The next is central bank and AI. Central banks play a crucial role in maintaining the financial stability, regulatory monetary policy, and overseeing financial systems, and increasingly exploring an AI to enhance the operational efficiency, risk management, and policy making capability, while also addressing the challenges and AI poses to financial sector. The key uses of AI by central bank is monetary policy analysis, financial stability and monitoring, regulatory compliance and supervision, which is RegTech, and fraud and cybersecurity is central bank digital currency CBDC. Global example is Federal Reserve is USA, European Central Bank, ECB, Bank of England, People's Bank of China, Reserve Bank of India. Challenges of central bank is data privacy and security, moral transparency, bias and fairness, regulatory and framework, and talent and infrastructure. Future direction is enhanced uses of AI to real-time financial system monitoring and crisis prediction. Further integration of AI in CDBC framework for secure and inefficient digital payment. The next is leading AI fintech company promoting financial inclusion. The financial inclusion means the providing the affordable and accessible financial services to individuals and businesses traditionally excluded from the former financial system. AI plays an transformative role by enabling the alternative credit scoring, macros, lending, and personalized financial services at scale, especially in emerging markets. The top AI-driven fintech companion in financial inclusion is Zest AI with USA, which focuses on the credit underwriting. Tala is USA Global, which is leading in emerging market, and Kiva, a global market peer-to-peer lending, and Jumo, South Africa, credit and saving for mobile user. Branch USA or Africa or India, mobile banking and loans. Koyo is a UK Fair Credit Access, and Fair Money France or Nigeria is mobile micro lending. How AI powers the financial inclusion is alternative credit scoring, benefit personalized lead lending, real-time decision and fraud detection, chatbot and voice AI. Impact of financial inclusion is credit for the first-time borrower and informal worker, and data-driven financial services designed for low-income groups. Challenges faced is data privacy, AI biases, regulatory gaps, and digital divide. Future outlook is greater adoption for federation learning to preserve user privacy, expansion of voice activity, financial tool, growth for a collaboration between fintech and NGO, and increasing the support from development bank and global foundation. Next is global collaboration on AI regulation. Global collaboration on AI regulation refers to the coordinated efforts among the countries, international organizations, and tech stakeholders to create an unified rules and framework that ensures the safe, ethical, and responsible development and uses for AI. Why the global collaboration is important, which is AI is broadless, prevents the regulatory fragmentation, address global risk, promotes the share and ethical standards. When challenges of collaboration is different political systems and values, and ensuring the participation from the global south and developing nations. Conclusion: the global collaboration and AI regulation is essential to balance the innovation with safety. It requires a shared principles, mutilated dialogue, and inclusive governance to shape the AI for the benefit of humanity. Role of the next is role of international alliance in AI regulation. International alliance are collaborative partnership between countries and global institution aimed to at addressing cross-border challenges such as regulation, artificial intelligence in a fair, safe, and consistent manner. The key roles of international alliance in AI governance is developing shared ethical standards, harmonizing the legal framework, enabling the cross-border data governance, and ensuring the safe innovation and risk mitigation, bridging the global inequality and AI access. The internationally alliance play a crucial role in shaping a unified and inclusive global AI ecosystem. By working together, nations can balance the innovation, ethics, and regulation to ensure the AI benefits of all humanity. The next is challenge key data challenges, data challenges, and AI. AI system depend heavily on the large volume of high quality data to learn, make prediction, and generate the insight. Without proper data, AI model can produce an inaccurate and biased result. Key data challenges in AI is data quality issues, data availability and access, biases, and data privacy and security concerns, labeling and annotation cost, and data integrity and compatibility, and real-time data processing. Data is the foundation of AI, but the poor data can undermine even the most advanced models. Overcoming these challenges is critical for ethical, accurate, and efficient AI development deployment. Next is interpretable of complex models. Interpretability refers to the ability to understand and explain how AI model makes the decision. It answers why the model predicts this or what features influence the outcomes. The type of interpretability is global interpretability and local interpretability. The popular interpretive technique is SHARP, which is sharply adaptive explanation, line, local interpretive model, egoistic explanation, and surrogate models. Interpreting is crucial for responsible AI, especially in regulatory industry, while complex model boost performance using interpretable method and tools and ensure the transparency and fairness and trust. Legacy systems and integration. Legacy systems are older software, hardware, and IT infrastructure that are still in the use, often because they support crucial critical operation but not compatibility with the modern technology like AI, cloud, and API. Next is shortage of skilled professionals. As AI adoption grows rapidly across industry, there is a significant shortage of skilled professionals who can develop, implement, and manage the AI system effectively. Why the shortage exists is fast-paced AI revolution and lack of interdisciplinary experts. Resistance to change. Why resistance is to change refers to the reluctant of refusal of individual teams or organizations to adopt a new technology such as AI due to fear, uncertainty, or preserve threat. Why people resist AI is fear of job loss, lack of understanding, comfort of status quo, under cultural barrier, unclear benefit and training and skill gap. Next is maintaining. The next is uh, maintenance and model update. In AI, maintenance and model update refers to the continuous process of the monitoring, evaluating, and improving the AI model and after deployment to ensure they remain accurate, relevant, and ethical over time. AI in vulnerability to cyber attacks, artificial intelligence systems, while powerful and transformative, also introduce unique security vulnerability, and a cyber attack can exploit this vulnerability arise both from the inherent nature of AI technology and from how they are integrated into a real world application. Next is high cost of implementation in AI. Implementation artificial intelligence solution involves substantial investment across various dimensions, making it high cost and for many organizations. These costs go beyond just buying the software and hardware. They can compress the entire life cycle from development to deployment and maintenance. Next is black box problem in AI. The black box problem is refers to the challenge of the understanding and interpreting how AI model, especially deep learning neural networks, arrive at the decision or predictive or prediction. This model can often operate with the integrate internal processes that are not transparent and not easily explainable to the humans. For example, healthcare and finance. Predictive model limitations. Predictive model often powered by AI is machine learning are tools used to forecast the future event or behavior based on the historical data. Despite the usefulness, this model have several inherent limitations and that impact their accuracy, reliability, and applicability. The next is the future of AI in finance is autonomous financial services. Autonomous financial services refers to the AI power system that can perform a wide range of financial operation with minimal or no human intervention. These services leverage the advanced AI, machine learning, robotic automation, process automation, and real-time data analytics to fear the fast, smarter, and more efficient financial decision making. The next is AI quant computing. Artificial intelligence and quantum computing are two transformative technology that, when combined, have the potential to revolutionize the computing problem solving and data analysis across the industry. Next is ESG investing with AI. ESG investing is environmental, social, and governance, focusing on evaluating companies based on the environmental impact, social responsibility, and governance practice alongside financial performance, integrating artificial intelligence into a ESG investing enhance and decision making by improving the data analysis, risk assessment, and portfolio management. The next is voice-enabled financial services. Voice-enabled financial services uses voice recognition, natural language processing, and AI technology to allow the customer to interact with the financial institution and manage the financial through the voice command. This emerging technology aims to enhance the convenience, accessibility, and customer experience. Next is augment intelligence. Augment intelligence is a collaborative approach where the artificial intelligence system enhance the support system human intelligence rather than replace it. It focuses on AI as a tool that assists the human in making better decision, solving complex problems, and performing for tasks and more effectively. Next is hyper-personalized finance. Hyper-personalized finance refers to the use of advanced data analytics, AI, and machine learning to deliver the highly customized financial products, services, and advice tailored precisely to an individual's unique preferences, behavior, and financial goals and life circumstances. Next is AI in financial literacy tool. Financial literacy tools aims to educate the individual on managing the personal finance effectively, covering the budgeting, saving, investing, and credit management, and more. An integration of artificial intelligence is transforming these days tools into a dynamic, personalized, and interactive learning experience. Next is AI for long-term planning. A long-term planning in finance involves the setting goals and strategies that span several years or decades, such as retirement planning, wealth accumulation, estate planning, and large-scale investment decisions. Artificial intelligence enhance the long-term financial planning by providing advanced analytic, predictive insight, and personalized recommendation that help the individual and organization make more informed and adaptive plans. The next is DeFi and AI integration. This decentralized finance is DeFi is a blockchain-based financial ecosystem that operates without traditional intermediary like banks, using smart contracts to enable peer-to-peer financial services. Next is sustainable finance in AI. Sustainable finance is integrates the environmental, social, and governance (ESG) criteria into a financial decision making to promote a long-term economic growth while supporting environmental protection and social well-being. Human AI collaboration. Human AI collaboration refers to the interactive partnership between the humans and artificial intelligence system, where both the complement each other strength to the achieve the better outcome, and either could alone instead of AI replacing human to approach the leverage and AI data processing and pattern recognition with human creativity, judgment, and ethical reasoning. Next is AI in financial metaverse. The financial metaverse refers to the virtual, immersive digital environmental where user can engage in financial activities such as banking, trading, investing, and asset management, and using blockchain, cryptocurrency, and other digital assets. Next is open banking powered by AI. Open banking is a system where the banks and financial institutions allow the third-party developer to access the customer banking data securely through application programming interfaces, which is APIs. Emerging is AI business model. Artificial intelligence is transforming traditional businesses framework by enabling new ways to create, deliver, and capture the value. Emerging AI businesses model leverage AI capabilities such as automation, predictive analytics, personalization, and data-driven insight to innovate across the industries. Next is Vision 2030 for AI in finance is that by 2030, artificial intelligence is expected to fundamentally transform the finance industry, reshaping how financial services are delivered, regulated, and experienced by consumer and institutions alike. This vision outlines the anticipated advancement, opportunity, and challenges of AI integrated in finance over the next decade. Let's see the key takeaways from the finance presentation is AI in transforming finance, personalized in critical, AI improves the risk and fraud management, human AI collaboration enhance outcomes, open banking and DeFi are accelerated by AI. Challenges remain and future trends include autonomous services and quantum AI, and security and privacy are paramount. AI benefit recap is increased efficiency, enhanced accuracy, personalized, improved decision making, scalability, risk mitigation, financial inclusion, better customer experience, etc. Risk and challenges recap is data privacy and security, algorithmic biases and fairness, lack of transparency and integration complexity. Strategic insight is start with clear objective, prioritize the data quality and governance, adopt the human input models, and focus on explainability and transparency. AI adoption approach is assessment and strategy development, build skills, start small, integrate system, ensure security, scale up, monitor and improve, and engage the stakeholder. Skilled for AI in finance is data analytics and statistics, machine learning, programming, domain knowledge, cybersecurity, awareness, communication, and ethics and compliance. Popular AI tools for finance is IBM Watson, Google Cloud AI, Microsoft Azure AI, Robot, H2O AI, Kensho learning platform certification is Coursera, edX, Udacity, LinkedIn Learning, certificate and artificial intelligence practitioner, CAIP, Chartered Financial Analytics, if AI focuses, and Google AI certification. Recommended books is Artificial Intelligence in Finance by Machine Learning and Asset Managers, etc. Key terminology is artificial intelligence, machine learning, deep learning, natural language processing, uh, algorithm trading, robo advisor, black box problem, predictive analysis, fraud detection, smart contracts, and open banking. So the final thought is AI is reshaping the finance by driving innovation, efficiency, and personalization, while challenges like security, ethics, and interpretability remain. Strategic adoption and human AI collaboration will unlock its full potential, staying informed and adaptive in key to thriving in this AI-powered financial future. These are the references and citations. These are for books, research paper and articles, industry reports, and website and online resources. Thank you.